Q and a W/Larry.
The dollar, why isn't it going up?
Because to go up, you need people to sell out of other currencies and buy the dollar.
That's not happening.
Evidently not. The dollar is not going up, is it?
Well, why not? Treasuries a bit higher every day, new low yields every day. Who's buying them?
Not foreigners.
Stocks are down 18% and bonds are up 18%. Is that a coincidence?
I think you just answered your last question about who is buying bonds. But that's only half of the story.
While stocks have been going down, their dividend yields have been going up.
Yes. Of the Dow 30 industrials, 28 have higher after-tax yields than the 10-year T-note.
Bonds don't change their payouts. Stocks can change their payouts.
Yes, and over the past year they have raised the average dividend 10% of those. Of course, many stocks lowered their dividends in 2008 and 9.
People on Social Security and pension plans like to see their checks go up each year.
Pension checks don't change. Entitlements are expected to change. And they will change when the government money runs out. They should buy top-quality dividend-paying stocks. Bonds will never increase the payout, and each time you roll them over, the yield actually has been going down.
So what's wrong with these people? This defies logical explanation. Why are stocks selling off?
Their mutual funds have been selling because they need to create fear. When that fear wears off, stocks will have one hell of a rally. A buy and hold forever rally, because the dividends paid 10-15 years out will be double triple what they are today, so you'll never give up that income stream. You won't be able to replace it.
Buy and hold forever. Like my marriage to Helga from the Fortune on Family.
Only better, the money comes in, not out. Bada boom bada pish.
Seriously?
Well, think about it. This is not new. This describes the rally from March 2009, big moves up.
And no volume on the sell-offs until recently.
Exactly. People don't want to part with their cost basis, or more importantly, their dividend basis. Dividends were lower in 2009, but stock prices were much lower, so yields were higher than today.
Treasury yields were higher last year.
They were higher a month ago, yes, much higher, 3.20% lima beans for the 10 years note.
Stocks are much more attractive on a competing yield basis today than a year ago.
Yes.
Than a year ago.
That sounds funny, like.
Am I richer than a year ago?
Than a year ago? Than a year ago? Burp, itching my ear. Than a year ago?
My God, the Donald. Or is it McDonald's? Who knows what?
McDonald's pays 2.75% dividend. Pause. Part of the fear is that the Bush tax rate of 15 will be raised to 38 or higher, making stocks less desirable, relatively speaking.
Any chance the cuts will be extended and the 15 rate will still apply in 2012 and beyond?
Yes, a very good chance. President Obama got the debt ceiling, his credit card limit, extended $2.4 trillion, and for sure he will use part of that to make stocks look attractive against bonds.
What about a QE3? You genius.
There's a very good chance, and this is what it will be. Buy stocks. And hear me, buy stocks that pay a dividend. Ever heard of the Philip Morris companies?
But what happens when rates go back up? Won't people sell stocks and buy bonds again?
Yeah, sure, rates go back up. After all the work the Ben Bernanke has done to lower rates. And don't forget, bonds move inversely to rates. The Fed has a giant portfolio of T-bonds, bigger than China's. He's not going to crush himself.
That's a good point. I'll have to ask myself that question.
Feel free. I'll wait, Lario.
Well, if rates stay low forever, then the Treasury rolls their debt over at lower cost to them, right?
Exactly, and theoretically, if your credit card is charging you 0.0000001% diddly squat rate, why would you ever pay them off? Just roll the debt. These investors are trapped, no principal paid back.
If $14 trillion in Treasury debt never has to be paid back, well, what are we worried about?
We should be worried about missing the boat again. Look at a chart of the S&P 500. This is a correction of the 2009 rally.
How can we buy stocks if all our money is tied up in treasuries?
Easy, open a margin account and borrow the money. Use those bonds as collateral, They will lend up to 90% tequila shots of face value. The banksters will gladly loan new money into existence. Loan new money. Benny and the Inkjets love that song.
Could you be wrong?
Have I ever been right? It could happen. Listen, the bank can borrow at a margin loan rate of 0%. I think he'll be buying more bank stocks. And I think he'll let the banks buy S&P 500 stocks, as long as they pay a dividend in cash US dollars.
With everybody buying stocks, there won't be any left.
Great point, Larry. How did you get so smart? Bernanke has been trying to corner the bond market for years now. He can see the future. He won't get repaid. He'll roll into new bonds at lower yields each maturity. Becoming an investor is the best part of his experiment that could have happened. Now he wants to corner stocks. And did I mention that stocks are a much smaller market?
But again I ask, won't rates go up and clobber bonds?
Rates won't go up unless the economy gets better and house prices stop going down. Don't worry, banks don't want to refinance homeowners and give up their income stream either.
It's all about the buyers.
Yes, and no sellers. Lock up the bonds, use them to buy stocks, let the dividends pay the margin loan interest, and watch the income stream increase over the years. It locks up the stocks too. Nobody will want to sell.
But what if the giant move in the bond market has nothing to do with front-running the Fed?
Well, that about wraps it up, folks. We're done with stocks for today. See you next time.
Past performance is not a prediction of future results.
Thank goodness for that. Hey, I think my watch is broken. Is it 2:15 yet?
Almost time for QE4. Goodbye.